All right, welcome back. My next guest, he's an unashamed bull, right? A big market bull. He's been on the show talking about a lot of the inputs that we just covered in the previous block with Nancy Tengler. But he's got a theme for this summer. He says it's our summer theme to buy the summer chop, right? And that played out yesterday, he says. He gonna use days like yesterday to broaden his stock exposure, and he believes the economy will boom over the next 12 months now that that big, beautiful bill has passed. Now, he goes on to say that today's downgrade of the banks is another buying opportunity. Big banks will be some of the winners due to the deregulation and the Fed easing over the next 12 months. We'd also like to get his view on whether or not interest rates need to be cut or not. So without any further ado, let's bring him on and see what he's got to say. Mr. Eddie Ghabour, thanks for coming on the show. Eddie, love to have your perspective. Great to see you, co-founder, Key Advisors Group up in Delaware. Nancy was pretty bullish. She thinks things are set up. You know, she also loves the fact that there's still people out there that don't want to believe it. They keep downplaying it. They keep poo-pooing it, and it's not really happening. But that just kind of adds fuel to the fire, doesn't it?
It does. And I don't want to see too many bulls come out because, as you know, once everyone's on one side of the table is usually when you need to start changing your thesis. But, you know, to her point, there's a lot of bears out there still. They just can't figure out why the market's going up. And that's their problem, is the market's telling you it wants to go up, and it doesn't matter what your opinion is. You just have to follow the market flows. And right now, it's about as clear as it can be that the trend is going to be higher. And that's why we continue to say is to buy the summer chop, because a lot of people missed the V-shaped recovery. And the headlines of tariffs that are going to cause volatility and trade deals, if there's one thing everyone should have learned in April is those are buying opportunities. It's not going to change the trend, and we are not, in our opinion, there isn't any data right now that has us even remotely concerned about a recession. And so you kind of put that all together, and with the amount of cash on the sidelines, they will capitulate at some point in time. So keep riding this market higher is going to be what we're going to continue to do for clients.
So you could be a skeptic out there. You could be a bear out there. You could be thinking, okay, we're going to get a chance here to buy it cheaper. And maybe that's the case. Who knows? I don't have a crystal ball. However, I think things are changing a little bit. Maybe you would disagree or agree. I don't know. But, you know, with all the tariff talk that we had yesterday, right, and all the stuff flying around about what we're going to be sending out to these 14 countries and the likes, and then you have Elon Musk starting his new third party, America Party. Had that happened end of March, early April this year, something similar to you, I think we would have had a much different outcome, a much lower outcome yesterday than we had. So I'm getting the feeling that now these bears are probably getting a little bit more impatient with the market because it's not reacting to the negative news like I think they'd like it to, and that also might be an impetus.
It is. You know, we've been talking about the fact that the dips will be more shallow than normal because so many people missed it. They're going to be forced to chase. And so, you know, you'll see 2 and 3% drops, but I think most of those will get bought and bought aggressively because they were caught off sides. And look, when you look at yesterday's news and you look at today and all the volatility, you have regional banks and small caps, you know, doing really well on those days. That doesn't happen in a bear market. You know, those are the places you don't want to be. And so that's why we said, you know, today's sell-off in financials on the larger side, we're looking at that as a fantastic opportunity. And we bought some yesterday, and we bought some today as well, too, for some clients.
So moving over to rates, I mean, you know, I've said it before, you know, he cut rates of 50 basis points in September right before the election last year. That smells. It still smells, if you ask me. But that doesn't mean I think that we have to beat him up and we have to have 2 rate cuts this year. I mean, I think we'll probably get 1, maybe 2. I'm in the camp of I'm a little agnostic. I think I'm leaning towards cuts, but I'm not, you know, banging the drum real hard. Where do you stand on that?
So I think they have enough data to justify a rate cut, and they probably will give us at least 1. I think the thing that people are missing is if they cut rates aggressively, I don't think that's good because that could cause the 10-year to go higher.
Yes.
The 10-year yield is much more critical to the path of equities and the economy than what the Federal Reserve does on the short-term rates. So, you know, if we're doing fine with trade where the rates are now, you know, why disrupt it? So I actually hope they only cut 1 time this year. That may not be a popular opinion, because I'm more worried about the impact on the 10-year note, because that's when the you know what hits the fan, is if it gets too hot, then it gets to 4.75 to 5, you will have we may be changing our thesis at that point in time.
And I think there also is a risk that he digs his heels in, he gets even more stubborn than ever before. And so when that dam breaks, he has to cut them sharper and lower and faster than he ever would have liked to before. What do you think about that risk?
Well, unfortunately, in my opinion, the Fed is always late, for the most part, on both sides. And so this is why I said the data that they're getting right now justifies doing a rate cut. I still think they'll wait till September. But when you look at when they cut rates last time and you look at the dynamics versus where they are now, they really, it doesn't make any sense as to why they wouldn't cut now. And so this is why everyone's kind of scratching their head as whether it was politically driven as to why they're doing what they're doing. I want to believe they're independent, but at the same time, I'm looking at how they're making their decisions and the data they're looking at, and I'm starting to question that right now.
Well, I mean, again, those tariffs aren't coming in inflationary like they're, this is a little bit political. It's naughty of me to say it, but I get the feeling sometimes by the tone of both the Fed and or some of these big market prognosticators out there, they almost sound defeated when they don't get the inflation numbers that they want to get. It's not coming through like they thought it was. And again, they've gotten it wrong, and the market's only rallied while they've stayed on the sidelines.
And here's another very important point to that as to why tariffs haven't been as inflationary as many people thought is our economy is so much different now than what it was 50 years ago. We are a service-driven economy, and you can argue that tariffs don't even impact that part of the economy.
They don't. You're right.
So the impact on tariffs may only impact 10 to 15% of our economy. So the net result from an inflationary perspective is not going to be what people initially thought. And so when you're wrong, you have to be humble and admit you're wrong and change. And that's what they need to do. It's not going to cause hyperinflation like they're worried about. And so if that's a reason why you're not cutting rates, that's not a very intelligent reason.
Yeah, well, the smart money that was out there buying, end of March and April, they knew that we have a $30 trillion economy. The stuff that's tariffable, if there's such a word, was going to be around about $1 billion, and of which you throw a 10, 20% tariff on that. What are we really talking about here, right? I mean, that was the world's largest overreaction. And I think those hedge fund managers, they traded that market by selling everything they had. They traded their politics. They didn't really trade what was really happening in the market. 10 seconds to you before we go.
This is why you have to have an objective, data-driven process and not let politics sway your decisions. Because if you base it on that, more than likely you're going to be wrong.
Yeah, you're exactly right. Well, you've been right so far. We're going to keep following you, Eddie. Thanks for being on the show. Always great to have you on. Eddie Ghabour, thanks for coming.